Hey everybody, Jason here. In this video, we're going to continue explaining total enterprise value and how important this number is and how important it can be, even more important than total enterprise value or than enterprise value. If a company has these kinds of assets and liabilities right here. So we're picking up right where we left off on the enterprise value calculation. Same numbers up here, same numbers right here. And I just rearranged the cash and cash equivalents down here because this is how I calculate it, just so I keep my numbers situated. So, forgot to add this down here. Equals. So, again, in this scenario, no matter what happens down here, the PE ratio stays the same. So this further illustrates why PE ratio is garbage and why I never use it. And why just by learning these two metrics, enterprise value and total enterprise value, you're going to be miles and miles ahead of most other value investors and business analysts. And yes, I'm including professional business analysts in this conversation. So here, same market cap, same PE ratio, same debt, same cash. All we're adding here is operating leases. What are operating leases? I'm going to explain what operating leases, unfunded pensions and retirements, short-term investments, long-term investments, and net deferred tax assets are in more videos and resources, specifically from $10,000 coaching training sessions. I'm going to give you guys access to those videos. They should either be below this video directly or in the very next session, depending on where me and my team decide on putting them. So there's going to be further explanation on all these, what they mean, their nuances, all that kind of stuff in those sections, which I highly recommend, highly recommend, because especially when it comes to operating leases, unfunded pensions, and deferred tax assets, there is a ton of nuance and a ton of what I like to call the art of value investing. A lot of this is very numbers based. A lot of what I do is very numbers and analytical based, but once you get past a certain level, a lot of it is nuance and art and based off what judgments and what you deem and what you are looking for in your particular investment. So I highly recommend you watch those videos and training sessions before moving on past total enterprise value, because again, this number can be extremely important. But for now, let's calculate these numbers for company 1 and company 2. So 100 plus 40 plus 70 plus 100 and then minus 0 over here. I'm trying to make this as kind of stark as possible here in the comparison, which is why there's zeros across the board here and numbers in this section over here. So 310 is this company's TEV, and this company 100 plus 0 plus 0 plus 0 minus 40 minus 10 minus 10 minus 10 is 30. So one company has a TEV of 310. One company has a TEV of 30. Again, if you're following along and paying attention from the last video, you're already kind of getting an idea of what this means. But I'm going to further illustrate what that means here. So let's bring back in those numbers. TV to EBIT, TV, free cash flow. Damn it. EBIT to TV and to, oops, sorry, I'm having major problems typing today apparently. So, EBIT, again, 10, 10, 10, 10. Sorry, I'm a little OCD when it comes to stuff like that, so I'm going to take my time to do that. So, one company I can already tell has a TEV to EBIT and TEV to free cash flow of 31 and 31. Again, the lower the better on both of these numbers. I look for any number under 8. So this company, again, its P ratio when we first started was 10. If you were to just use the P ratio like most even professional investors do, you would say company 1 is about 2 times or about half, 2 times more undervalued than company 2. Again, everything we're doing here and in this entire program, in this entire masterclass, is to dig deep and become great value investors and business analysts. We don't want to do what the average does, because the average over time loses money in the stock market. We want to beat the stock market over the long term, because that's how we create wealth. I don't know what just happened there. So, this company, their EV was 6. When you bring in all of their extra stuff here, their EV drops even further, and at least on a relative basis. And I say it that way because these are only 2 metrics. And these are what I call, or what are called, relative valuations. I value companies several different ways when I do any business analysis. I do that. I don't rely on just one metric or one set of metrics or one set of valuations to evaluate any company. I evaluate all businesses on every metric I use, all analysis points, all risk points, because I want to see the entire picture of the company, not just one metric. So I always state it the way that this company could be overvalued and this company could be undervalued, because until I do the full analysis, I don't know. Other risks could come out where this company is actually better. Other risks than this company. It could be too risky. Maybe their management is terrible. Maybe this company has spectacular management. Maybe this company has a new major breakthrough that their profitability metrics aren't necessarily showing up yet, and they show up in the next few quarters. Maybe this company is a terrible operating business. Maybe they just have balance sheet value and their operating business is terrible. So you have to do the entire analysis. Again, that's why I term it, this company could be overvalued, this company could be undervalued. Again, to further illustrate this point. So, do the inverse again. EBIT 10 divided by 310 is 3.2%. 3.2%. And this is should be around I believe 33.3%. Yep, 33.3%. So, when we first went through the EV evaluation of these 2 companies, actually, let me step back. When we first began looking at these 2 companies, again, like most investors do, they just look at the P ratio. Company 1 looks better than company 2. Just by doing this, which took us, once you get this information down and know exactly where to find this information in the financial statements, which again are in those resources, in those videos, which I highly, highly, highly recommend you watch. You can do this for an entire company in 5 to 10 minutes. It's that quick and that simple. What we found out really quick by just doing the enterprise value is that company 2 is far better, has a far stronger balance sheet than company 1, and it's less risky, not only because of that, but because it's more undervalued, at least on a relative basis. What we found when we brought in total enterprise value is that company 1 is, again, at least on this single metric and set of metrics, looks to be massively overvalued, and company 2 looks to be massively undervalued. How do we know that? I look for anything under 8 here. The lower these numbers are, the better. Why though? Because earnings yield right here, which again will explain all of this and what everything from here down means in further future sessions or lessons. But the lower these numbers are, the higher these numbers are, and the higher these numbers are, the higher we should the more we should expect to earn owning this company in the next year. So owning company 1 within the next year, we should only expect to earn 3.2%, which is horrible. Owning company 2, we should expect to earn 33.3% within the next year, which is fantastic. Again, this is one set of metrics, so we need to do the rest of the analysis. I would discard at this point company 1. This is part of what we're doing, the preliminary analysis. We're building up towards my preliminary analysis template, and to discard crap companies faster and find great companies quicker. And at this point, I would want to do further research on the hypothetical company 2. I will see you in the next videos when we talk about